All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options midweek update. I know we're going into a holiday stretch here the next few days. We're going to have some slower trading this afternoon, and then as we wrap up the week on Friday. But I did want to jump on, show you guys some of our trading from this week. We'll also highlight some things that we're looking at going into next week as we settle back into more of a normal trading environment. If you have any questions on today's session, feel free to type those in at any point. If you are reviewing the recording on YouTube or Facebook, feel free also to post comments and questions there, and I will get back with you as soon as I possibly can. So let's go ahead and jump on. G, let me know if you can hear me at this point. I would appreciate it if you would just give me a quick comment and so let me know that you are hearing me. Okay, want to make sure that we're good to go. All right, so let's go ahead and start out by taking a look at the daily chart of SPY. This is our typical starting point here. I love to start out with this daily chart because it gives us a good glimpse as to where we're at big picture. Again, this is not a chart that I'm using to base my entry and exits off of. It's just a chart that I use to gauge how aggressive or conservative I want to be. Meaning, do I want to use more weekly options or monthly options? Do I want to use long calls, long puts, or more vertical spreads? And am I using a normal position size? I like to base my decisions not off of what the news is telling me to do, not off of what CNBC or Bloomberg or Twitter is saying. I want to base it off of price action on the charts. And when you take a look at this daily chart, I've got a handful of very typical moving averages here, just a mix of simple and exponential moving averages. And you can clearly see the last few weeks, it's been an impressive move to the upside. We've had a lot of sector rotation going on here on this latest move to the upside. It really has been led by retail, by the financials, by energy. Tech has been higher, but it's lagged behind. We haven't seen the explosive move to the upside out of the tech sector. Now we're starting to see some rotation yet again, where you've got the Dow and the S&P and the Russell, for that matter, lower on the session. You've got the NASDAQ stronger. We continue to see that never-ending rotation. There's always that area that's strong enough to prevent any type of weakness market-wide. Until that whole rotation breaks, we're going to continue to see a market that continues to plow its way higher. We may get some pauses. We may get some consolidation. But unless we get every sector, every index down at the same time, it's going to be very difficult to get anything sustainable on the downside. Do I think we're overdone here? Do I think we're overbought? Yes. I'll show you some charts in just a moment to quantify that. But long-term, going into the end of the year, at this point in time, based on price action that we're seeing, you'd have to expect another push to the upside. We're only a stone's throw away from all-time highs on the S&P. You would have to expect another move up towards those highs here between now and the end of the year. What would change that? Obviously, price action can change in a hurry, especially with all the unknowns these days with the pandemic and with a transition of power here in the U.S. starting to take place. A lot of unknowns here, and anytime you have that uncertainty, that cloud hanging over the market, it can cause those immediate changes in direction. Now, I'm not going to sit there and put on positions expecting the market to collapse, right? I'm going to base my decisions off of what I'm seeing currently given the price action. So if we're going to get anything going on the downside, at a very minimum, we've been talking about the 8-period exponential moving average in recent sessions. It's that solid pink line on my chart. It is currently sitting at 358.82. That is a very key reference point on the downside. Until that level breaks on a closing basis, it's going to be more difficult to get anything going on the downside with any type of follow through. We may get these little pushes to the downside for a few hours at a time, but until we break some of these support levels, we're just going to continue to see the buy the dip scenario play out. You can see over the past week or so, we have tested that 8 EMA multiple times. Let me zoom in here so you can see it in more detail. If we zoom in, you can see that 8 EMA has been tested multiple times, and every time it's tested, we see the buyers step in and take us right back above that level. That's going to be our key area on the downside. If we do break it next week, we've got this nice little air pocket between the 8 EMA and that next green line is the 20 period. exponential moving average. We could see a very quick move down to that level should we get any type of selling pressure picking up next week. If we continue to see this move higher, our nearest area of resistance is the all-time high at 364.38. We tried to test that level yesterday, or right up near that point again today, and you can see price action having a hard time breaking through that level because you've got a lot of names that are tired. We've had some tremendous runs to the upside. Not to mention, the volume is very, very light. That's very expected here today. Markets are closed tomorrow. We've got a partial day on Friday. You're looking at lower volume, and it's going to be difficult to get this market to plow up through a very key resistance point unless we get some pickup in volume. I would not expect anything significant in either direction until we come back from the holiday next week. Now, the volume, we've been struggling to hit 50 million shares here the last couple of weeks. That's a very low number historically. To put that into some context, what we normally want to see, big picture, is we want to see 80 to 100 million shares trade on SPY. When the volume gets light like this, you tend to see more choppy conditions, and it becomes more difficult for us to get fills on trades. I want to see that volume pick up. I want to see the liquidity improve here, and I do think that'll happen. Again, starting next week as we come back from the holiday week, between Thanksgiving and Christmas, you've got that window, and I expect the market to be very active during that time frame. So again, all-time high, 364.38. That is our area of resistance. And then the near-term area of support down below us, the 8 EMA, down at 358.83. The ATR, the average true range. This is the scenario that we've covered the last couple of weeks. And I've talked to you guys about how we did not want to see the ATR continue to contract. And boy, has it contracted. I mean, we have seen this thing really move to the downside the last couple of weeks. We have gone from over 7 back earlier in November to where we're at currently, just above 5. Now, above 5, that's a decent number. It still indicates that there's some range in this market that we can work with. But we do not want to see this continue to contract, because when you start to see lower range in the market combined with lower liquidity, that becomes a very challenging environment for active traders. We want to see that whole thing flip around. I want to see the ATR pick back up. I want to see it expand. I want to see the range expand intraday. And I also want to see the volume expand. I don't need these one-way moves. I don't need the market to completely collapse. I just want to have some two-way price action. And right now, at least the last couple of weeks, we've had very little two-way price action to speak of. The session today, if you take a look at the internals, the volume ratio in the upper left-hand corner, slightly negative on the NYSE, slightly positive on the NASDAQ. What's interesting there is if you take a look at the NASDAQ, you've got the NASDAQ futures up 40 points. Nice little rally there in the NASDAQ. But when you take a look at what's going on under the hood, number one, the volume ratio is barely positive. There's not a lot of volume behind the move. And then if you take a look in the upper right-hand corner, the advanced decline line, taking a look at the NASDAQ, how many names are positive versus how many names are negative, there's actually more names moving to the downside than the upside here today. This is not across the board buying. It's buying in a couple of key areas. You've got Apple up 75 cents. You've got Amazon up $62. You've got Google up $3. Those key big tech stocks are higher today, and that's all that's needed today to prevent any type of significant weakness. The reason I point this out, it's very easy to come in and get misled by the overall index numbers. They might paint a picture that's different than what's truly going on. What I'm seeing here intraday is I'm seeing very tired conditions. This is not across the board buying. In fairness, it's not across the board selling either. We're kind of in that no man's land where we're extended. We've already seen the market make a move, and now we're just in a holding pattern. Not a time that I really want to get overly aggressive with putting capital to use. We can still stay active. We can still take trades, and I'll show you some potential markets that I'm looking at here in just a moment. But I'm going to be more conservative in the strategies that I use. I'm using a lot of credit spreads here this week because we're going into a stretch here the rest of this week that's going to be very slow. I want to get that time decay working in my favor. If you're going to buy options here today, it's going to be more challenging because the volume is going to be light. You're going to have a slow market, and the time decay is working against you if you buy an option. I'm trying to flip that around and trying to stack some things in our favor here, knowing that we're probably in for a slow end of the week and potentially a slower start next week as we get back from the holiday. The tick in the lower left-hand corner, We don't have any major tick readings here today. We don't have any moves above plus 1,000 or below minus 1,000. Those are the levels that I look at to indicate buy or sell programs kicking in. We have none of that today. It's very, very muted price action, and you can absolutely see it over on the 5-minute chart of the S&P. Look at that 5-minute chart of SPY. It is absolutely straight sideways. Not much going on. Very, very typical going into a holiday stretch. So it's really easy to say, okay, I want to be active. I want to find things to do. I'm a market addict as well. I want to be active as much as I can. But these are the sessions where you want to take a step back. Don't try to force it. Be very careful with the strategies that you're using. This is probably going to be the story here the next couple of days. Going into the end of the week, we're probably going to see slower markets. Markets are closed tomorrow, partial day on Friday. You're probably going to see more indecisive price action than an explosive move. So where does that bring us? Well, I've already started to touch on it. I want to be more conservative in the trades that I'm taking. That means I'm looking at more credit spreads. And one of the trades that we put on here yesterday afternoon, I've talked about this approach the last couple of weeks. It's what we call our overnight pop trade. It's a trade that we look to put on going into expiration. Now, why am I talking about expiration? It's Wednesday. Well, SPY is one of the only products that has those midweek expiration cycles. It has Monday, Wednesday, and Friday expirations. Yesterday afternoon, we actually came in and we sold a call spread knowing that those options are going to expire today, and we're looking to take advantage of the extreme time decay that is there the last 24 hours before expiration. What we took a look at yesterday afternoon, we sent this trade out to all of our members. We had our pulse indicator down at the bottom. And don't want my computer to run out of battery here, so let me make sure it's plugged in. Just give me a quick second, guys. We just moved, me and my family just moved out of state here this past weekend. So I'm still trying to get my new office set up and trying to make sure all the cords and cables are plugged in, and had to make sure my computer had power here for the next few minutes. All right. So what we did on the trade yesterday afternoon, we have our pulse indicator down at the bottom. It's the red and yellow histogram. Notice what happened the last couple of days. That indicator plotted yellow. That indicates an overbought condition. What makes it overbought? What that indicator looks at, it uses standard deviation channels, and it'll plot yellow when price is between a 1 and a 2 standard deviation move on the upside. What that indicates is price is at an extreme. Doesn't mean price can't head higher. It just means it's at a level that will typically lead to a period of consolidation or a reversal in the other direction. I've shown you some examples here on these charts lately. Just use SPY. Look at all of these examples. When we had yellow and green bars in the pulse, we had one back in end of October. We had an oversold condition because those bars were plotting yellow on the downside. It led to a nice push higher. We had another stretch in September. Got oversold on the pulse indicator. It led to a nice move higher. If we go back to late August, early September, last time we had an overbought condition on the pulse. We had yellow bars on the upside. It led to a nice move to the downside. It's a very repeatable pattern that we will see over time. Now that we're starting to get some yellow bars here, it indicates that we're overbought, and it's just going to make it more challenging for the market to move higher. It's not impossible. It's just not statistically probable. Odds favor a period of consolidation or even a reversal lower. Add to the mix that we're going into this holiday shortened week. So what we did yesterday is we came in and we sold an out of the money call spread. If I want to put on a neutral to bearish position, if I'm looking for the markets to pull back, why not just buy a long put? Because if you buy a long put, you only have one way of making money. You only make money if SPY moves to the downside in a pretty big way, and it does so relatively quickly. What if I don't want to be that aggressive? What if I want to be a little bit more conservative? Selling an out of the money call spread is still a bearish position, but it gives us multiple ways of making money on the trade. What we did, we came in and we sold the 364, 366 call spread. All that means is I am selling the 364 call, and at the same time, I am buying the 366 call. I'm just trading two options at the same time. It gives me a risk-defined trade. I collect money up front to put this trade on. I am paid 55 cents or $55 per spread to put the trade on. It's tying up $145 of my capital per spread to put the trade on. The whole goal here is to sell high and then buy it back lower the following day. That way we can pocket the difference. What would cause those options to get cheaper? We could make money on this trade if SPY moved up, down, or sideways. It did not matter to us as long as price stayed below 364, 364.5 to be exact. We also made money from the time decay adding up, which time decay is extreme with only 24 hours left before expiration. And we can make money from the volatility decreasing. There's 5 different routes that I can follow to make money on the position. Well, what happened here this morning? Has it been the biggest move to the downside on SPY? No. SPY is down about $1. It was down a little bit more here earlier in the session. Well, the beauty on this trade, we just need a price to stay below 364. We can check that box. Price has stayed below that level. We know the time decay is extreme. We can check that box. The time decay helped us. And the volatility, pretty flat. Okay, the volatility hasn't really done much today. So we've had multiple factors working in our favor today, and we were able to close out of the spread. We bought it back this morning for 13 cents. It gave us a $42 profit. That's a 29% return on our capital in less than 24 hours. We initiated this trade around 3:30 p.m. Eastern time yesterday afternoon, and we closed it out during the first 30 minutes of the session here today. We're in and out less than a day. It gave us $126 of profit following our risk parameters. And what I mean there is we track these trades risking $500 of capital on each position. Okay, just to try to stay consistent and use a similar dollar amount on every trade. At initial glance, you're saying $42 of profit or $126 of profit doesn't seem all that impressive. You've got to remember that we only tied up $145 of our capital per spread to begin with. We had 5 ways of making money on the trade, and we were in and out in less than 24 hours. If you've got a bigger account size, nothing says you can't take this trade with 10 spreads, 20 spreads. You put it on 10 times, now all of a sudden you've got a $420 profit overnight. You start to put a couple of these trades on a week, it definitely adds up. It's this nice little supplemental income, potentially even replacing an income. And we're only looking at the markets a couple days a week, trying to take advantage of these moves going into expiration. Really great trades. It doesn't mean we're going to win on every trade, right? I mean, we're going to have losers along the way. But when you start to stack the odds in your favor, when you start to take what the market's giving us, it really opens up a whole new universe for us, right? You're not locking yourself into just buying calls and puts all the time. I love to buy calls and puts. It's a big part of what I do. But I also want to have other strategies at my disposal because I know market conditions will change. We're going to have these holiday weeks from time to time where I can adjust accordingly to take what the market's giving us. And it worked out really, really well for us. Now, what do we do from here? What do we do going into the rest of this week and early next week? Well, if we take this current trade out of the equation, I'm just going to go ahead and drag it off the screen here, or at least over to the left-hand side so you don't get distracted by it. Looking at price action over on the right-hand side, nothing has changed as far as us being overbought. This market very overdone on the upside. Doesn't mean it has to fall apart. It just means we're probably due for a pause. We're probably due for a pullback. And I talked about it last week. If we're going to make a run, a sustainable run up to new all-time highs, I personally believe that we're going to need to see a pause or a pullback first. If we just continue to move higher here, the problem with that is you're going to continue to see volume contract. You're going to continue to see range contract. Not something we want to have happen as active traders. We want to see the exact opposite, right? So my outlook going into next week, if you need positions, if you need to be active on SPY, I would continue to favor the credit spreads. I would continue to take a look at selling out of the money call spreads. Can you put on a trade here today, looking to take advantage of the Friday expiration? You could. Or you can hold off and take a look at the Friday into Monday stretch as well. Okay, perfectly acceptable either way. I am going to continue to play with a neutral to bearish outlook in the very near term. Again, I mentioned earlier, I do believe that we'll probably get another run to the upside between now and the end of the year. But in the very near term, over the next 3 to 5 days, I certainly could see an opportunity for a neutral to more bearish outlook. All right. Let me quickly just taking a look at my notes. Let me quickly cover on the spread that we took off this morning. Why did I close it out for 13 cents? Why not just hold it into expiration? I mean, as long as price stays below 364, why not just hold on to the end of the day and book the entire profit? The reason I closed it out this morning is we were able to close it out, book the profit in the first 30 minutes. Had I held, I'm going to have to watch this thing closely all afternoon. I don't want to be tied up. I don't want to be caught just watching markets all day. I'd rather close the trade out, free up the capital, and free up the rest of my day for other things. What we don't want to have happen is have this trade work out really nicely first thing in the morning, and then this afternoon, what if we get that low volume rally into the close? And what if price goes above 364? You're going to go from a really nice profit to an immediate loss. I'm not willing to take that risk. I find it's better. The odds favor booking the profit, ringing the register, and just freeing up the capital for the next round of new setups. So that's exactly what we did on SPY. So again, leaning a little neutral to bearish in the near term for the next 3 to 5 days. And then as we jump back on midweek next week, we'll reevaluate it. We'll see if we got a deep enough pullback to reset things for another push to the upside going into the end of the year. I mentioned how we do have that rotation going into the NASDAQ. Let's take a look at QQQ here next. You can see it's a very different looking chart than what we just took a look at on SPY. Yes, the NASDAQ has been higher the last couple of weeks, but it's just been more of a drift mode, right? We just kind of been drifting more sideways than anything. We're still in a bullish outlook because our trend strength histogram is still blue. But is this a level that I really want to initiate any aggressive long positions at? No, I'm not really interested in that approach. I'm kind of in a holding pattern here on QQQ. Just like SPY, if you wanted to put on a new position here today, I would favor the credit spread side of things. But out of all of the index products, I would say QQQ, just given the chart pattern, that QQQ is probably my least favorite at the moment. SPY presents a better opportunity. And then if we take a look at IWM, this is the Russell 2000. I mean, you'll see the difference in chart patterns here immediately. I mean, the Russell has been just super strong on the upside. Let me get those notes out of the way so it's not distracting. So if you take a look at the Russell, if I want an index trade on, I much prefer the Russell because you can see it's been an explosive move to the upside. We're very overbought. The pulse indicator is plotting yellow, again, indicating that overbought condition, indicating price between a 1 and a 2 standard deviation move on the upside. I do think there's room for a pullback here in the near term. I would absolutely be interested in selling call spreads here on IWM. I've already put one trade on IWM this week, selling an out of the money call spread. And I would be interested yet again to add to that position, start to layer in some different positions in IWM. I do think that's an opportunity because if we are going to see this market rotate here, you're probably going to see money come out of the small caps and potentially go back into the NASDAQ. We'll see if that plays out or not. So if we're going to expect a pullback here, I do like SPY and IWM out of the index products. Another trade that we took off here today was on First Solar, symbol FSLR. If we take a look at this chart, you will see that our trend strength histogram down at the bottom went from red to blue. That happened last week, indicating bullish momentum taking over. We also at the same time had price close above not only our 8-period exponential moving average, that's the red and blue line, but also our white and yellow line, that's the 50-period EMA. Once price closes above those levels, we're interested in putting on the new bullish position. That's exactly what we did. And let me show you over on the trade page what we did. We went out to the December monthly options. I've been trading a lot of December monthlies here. They have 23 days left to expiration. I normally like to see between 20 and 40 days left to expiration on the options that I trade. Not to mention the monthly options will typically give you better liquidity, better volume, better open interest, just makes them easier products to trade. And we came in and we bought the 87.5 calls. Again, we did this back on Monday. And we paid $4.40 for this position, tied up $440 of our capital per contract. We ended up closing out of this trade and you can see right now it's trading for right around $7. So you're taking a look at that saying, okay, you're selling it out of at $7. Why would you do that? If the trade's moving in our favor, why not just hold? I mean, the market's strong. Why not just continue to hold? Normally, I like to see these trades at least have a chance to double my money. Well, closing it out right around $7 here today, it gave us around a $260 profit per contract. That's a pretty nice profit, right? Not 100% return, but it's a really nice return, right? We're up 50% on the trade. The reason why we close it out is because even though the market's closed tomorrow, and we've got a half day on Friday, time decay does not stop when the market's closed. Time decay is still there tomorrow. Time decay is still there over the weekend. And what I don't want to have happen is with 23 days left to expiration, if we don't see much out of the market, obviously the market's closed tomorrow, we might not see much on Friday. If we don't see any decent price action until early next week, you're taking a look at 4, potentially 5 days of time decay that can get sucked out of those options. That's going to hurt a long option position. What I would rather do is take the profit. The market is overbought. We've already talked about that at length here today. What I would rather do is book the profit, free up the capital, and not have to stress about it here over the holiday weekend. That all went into my analysis. That's all went into why we initiated the closing alert here earlier today to book the profit. Never a bad thing to ring the register, right? Very hard to pick market tops and bottoms. You're always going to feel like you're leaving something on the table, but when you're ringing the register like that and you can take a 50+% profit out of a trade in a couple of days, yeah, we're definitely going to take advantage of that with a holiday coming up. All right, so that was First Solar. Let's go into some of the names. I mentioned the market very, very overbought, and I mentioned that it's really been led on by the retail names, by financials, by the energy stocks. Those are the 3 areas that have been ultra strong. Let's take a look at some of these. Target, symbol TGT. Definitely an impressive move to the upside. They've had very little on the way of a downside price action now for the last number of weeks. And look at our trend strength histogram down at the bottom. I've talked about the pulse indicator already today. We ideally need to see yellow bars there to indicate an overbought condition. We don't have yellow bars there. There is one other potential setup that I can look at. The trend strength histogram down at the bottom. It's the red and blue histogram. When it's blue, bullish momentum is in control. When it's red, the bearish momentum is in control. Well, notice how the trend strength histogram got all the way above 7 here. When I see that trend strength histogram get above 6, that indicates an overbought extreme. It has me potentially looking at a pullback in the near term. Now, have I put a trade on target yet? Not yet, because price action is still pretty darn strong here. What would I be looking at going into next week? If I want to play a pullback, one option is just to buy a long put. But as I mentioned earlier, that only gives us one way of making money on the trade. I would rather have a higher probability of success. This is another candidate for selling an out of the money call spread. That allows us to lean a little bit bearish, allows us to do so in a more conservative way. And especially with the slow end of the week expected with the holiday, it's just going to be a better use of our capital. It's going to take what the market's giving us. So target, definitely a candidate to sell an out of the money call spread. And what would that look like? If I go over to the trade page, switch this from First Solar to target, I'm going to stick with the December monthly options. As I mentioned, that's really been my area of focus here the last couple of weeks. I've really traded a lot of the monthlies. If we go out to the 182.5 calls, why did I select the 182.5 calls? Because they've got a 62% chance of closing out of the money. When I take a look at selling a spread, my starting point is always to go to the option that has close to a 65% chance of closing out of the money. If I right click on the 182.5 calls, go to sell and go to vertical, it's going to pop up an order down at the bottom. It has me initially selling the 182.5 call and then buying the 185 call at the same time. With there being a $2.50 difference between the strikes, I want to collect between 75 cents and $1. I want to collect between 30 and 40% of the width of the strikes. Well, if you take a look at the spread, we're trading for 84 cents here. So that meets my criteria. It's between 75 cents and $1. The 83 cents that I could collect is the most I can make on the trade. That's my maximum profit potential. My maximum risk is $167 per spread. I'm right around risk 2 to make 1. I'm okay with that ratio because we've got 5 ways of making money on the trade. We make money if the stock moves up, down, or sideways. As long as it stays below 183.33, we're okay. We also make money from every day that passes. The time decay is working in our favor. And we make money if volatility continues to decrease. Any of those 5 routes would allow me to make money on the trade. We're tying up far less capital when compared to just buying an outright call or put. We're giving ourselves potentially 5 ways of making money on the trade. It's a lot better position, in our opinion, given the current conditions. So that is one of the trades that I'm looking to put on here over the next couple of days. Do you have to get into it now? Well, if you take a look at the chart, I mean, the price action is still pretty darn strong here. One of the filters that we teach our students is, instead of just jumping in and selling a call spread because the market's overbought, one of the filters that you can use is to wait for price action to close below the 8 EMA. Have it close below that red and blue line. Wait for price action to start rolling over first. You're going to miss out on the first part of the move, but in exchange, you get confirmation that price action is indeed ready to head lower. Certainly something that you could wait for going into next week. Now, just continuing on with the retail names, if we go over to the retail ETF, let's go to ETF land here for a bit. I love to trade the ETFs because they're pretty darn liquid and they just give you instant diversification. Instead of picking one individual stock like Target or Walmart, we're able to look at an entire ETF here. XRT, very overbought. We do indeed have yellow bars on the pulse, indicating price between a 1 and a 2 standard deviation move on the upside. This is also a potential name to sell an out of the money call spread on. It gives us a high probability of trade. It gives us a position that ties up less capital. Going into next week, if we do start to see price action roll over, if we do start to see the trend strength histogram go from blue to red, then we could absolutely talk about buying long puts. But at this point, we don't have the green light to do that yet. I'm focused more so on the credit spreads at the moment. So XRT, definitely on the top of my watch list going into the end of this week, early next week. You could wait for price action to start heading lower and get a close below the 8 EMA first. Perfectly fine with that approach. And then as far as how to structure the trade, we would take a very similar approach to what we just talked about on Target. Switch the symbol here. We're talking about using the December options. We're talking about using the out of the money call options. And let's go to the 62 calls. They have around a 63% chance of closing out of the money. Let's right click on them, go to sell, go to vertical. And let's take a look at the 62-64 call spread. All I'm doing there is selling the 62 call and buying the 64 call at the same time. There is a $2 difference between those strike prices. Again, I want to collect between 30 and 40% of the width of the strikes. I want to collect between 60 and 80 cents. This one's trading for 67 cents. Perfect. Meets my criteria. I'd be risking $133 to make 67, right around risk 2 to make 1. Very typical range for a credit spread. Our break-even point's at 62.67. We're okay as long as price stays below that level. I don't care if it moves up, down, or sideways. Doesn't matter to me. As long as price stays below 62.67, we're okay. The only move that hurts me is a big move higher, which on many of these names we're not expecting because the market's already overbought. Right? We also make money if time decay adds up, which it absolutely will, and from volatility decreasing. So now we have a position that's tying up less capital when compared to buying a long call or long put. And it's given us 5 ways of making money instead of only having 1 way of making money with the long call, long put. So a lot to like about this type of trade. Now, in fairness, I mean, if you take a look at these credit spreads, there's a lot to like about them, but you are giving up your home run profit potential. If we do get this market to pull back, yes, we're going to have a lower return on the trade. You're not going to have 100% return overnight with a credit spread. But what you can see, you can see that 20 to 40% return on your capital within a couple of days with 5 ways of making money. It's a fair trade-off. I would gladly, in many cases, give up that home run profit potential in exchange for a higher probability of success. XLE, this is the energy ETF. Energy has been absolutely on fire here the last couple of weeks. Probably the strongest area of the market as a whole. Probably a tug of war there between the retail and the energy names. Well, XLE, very overbought. How do I know that? Not only is the pulse indicator plotting yellow, it actually just went green the last couple of days, indicating that prices between a 2 and a 3 standard deviation channel move on the upside. Again, doesn't mean it has to move lower. Doesn't mean it can't head higher. It just means it's not statistically probable. What you'll typically see is when you start to get these extremes, at some point in the near future, it doesn't have to happen immediately. Sometimes it takes a couple of days. Sometimes it takes a week. But in the near future, you'll typically see a period of consolidation or a reversal. And you'll see yellow bars in the pulse didn't mean that price reversed immediately. Price has continued to move higher. But now here today, we're starting to see a pullback here, a well-deserved pullback. It does not mean energy is completely done on the upside. It just means it's tired. We're due for a pause, and we're starting to get that pullback today. We'll see if that continues going into next week. So this is another candidate for selling an out of the money call spread. Definitely another one that I'm looking at. So you follow the same criteria that we talked about on Target and XRT. We go to the December monthly options and we talk about selling an out of the money spread where I can collect between 30 and 40% of the width of the strikes. All right, the final one is XLK. This is the tech sector ETF. As I mentioned earlier, I could very well see, and we're actually starting to see it already today, that rotation out of some of the small caps, out of energy, out of the financials, and back into tech. We could very well see tech take the baton again and lead the charge to the upside into the end of the year. XLK just gave us a new long trade. The trend strength histogram went from red to blue right here down at the bottom. We saw price action above our moving averages. We did come down and test both the 8 EMA and the 50 EMA. Price found support here earlier this week, found support right on top of the 50 EMA. We've bounced off of that level. Price action looks poised to head higher from here. So if I go over to the trade page, this one, I would be open to putting on a long call. Why? With the trend strength histogram still blue, just flip back to the blue side, indicating bullish momentum taking over. That gives me the green light to buy a long call. I'm still going to use the December monthly options. And when I trade the long calls, long puts, I typically want to get a couple strikes in the money. My sweet spot is I ideally like to see a delta between 0.6 and 0.65. I want to make sure there's good volume and open interest. I want to see good liquidity. And that had me looking at the 120 calls. Gets me slightly in the money. You're talking about just under $400, around $390 per contract to put that position on. That gives me a bullish trade. It's a more aggressive trade. I love the chart pattern. My only concern is just with the holiday stretch over the next couple of days. Not always thrilled the Wednesday before Thanksgiving, putting on a new long option position, but that's what the chart is giving me. So I could cut back my position size, maybe put on 25 to 50% of my normal position size. I'm fine with that. But I do see some potential there on the upside for the tech sector going into next week. So some bullish exposure would actually be a welcome sight. My overall portfolio in the near term leans bearish. So I wouldn't mind having at least some bullish exposure. And for that, I definitely like the tech names. All right. So again, I'm expecting slow trading this afternoon, slow trading on Friday, and then we'll revisit things here again next week, coming up on Wednesday for our next midweek update. On Friday, guys, I mean, with the market only open part of the day, it's going to be very slow on Friday. I'll do my best to jump on for a weekly recap. It might just be a shorter video where I pop on for 10, 15 minutes or so. We'll just have to see what the market does between now and then. If nothing changes and we're just seeing a very slow dull market, we'll just pick things back up again next week. So if you have any questions between now and then, feel free to email me directly, mike@netpicks.com. If you have any questions here at the moment, feel free to type those in. If you have any other markets you'd like me to take a look at, let me know now. Otherwise, I'm going to start to wrap up here for the session today. Enjoy your Thanksgiving, everybody. Enjoy the good food. Hopefully some good football, fingers crossed. And then we'll talk to you guys either on Friday or early next week for our next video. So enjoy the weekend, everybody, and we'll talk to you guys here very soon.